Today, we're going to be doing an AMA and Ask Me Anything. So as you guys come in, hopefully you guys have prepared yourself and you have some questions for me. So go ahead and type those into the chat box or type them into the Q&A box, whichever you feel more comfortable with. And we will go ahead and get started with this in just a moment. So for those of you who have not been with us before, I do want to mention to you that a little bit about myself first. So my name is Dan Handford. I am one of the managing partners of a group called PassiveInvesting.com. And let me just bring up our screen here so you can see this. This group is a national multifamily group that acquires properties primarily right now in the Southeast and the Carolinas, as well as Georgia and Florida are some additional markets that we're expanding into. And you can go here to Meet the Team. When you click on Meet the Team, and there is a list of the people that are part of our team. So you can actually click on my name if you want to find out more information about me. And you can see this right here. So I am located here in Columbia, South Carolina, and I have 4 children, all under 10, at least right now. Next month, I'll have our first double-digit child. She'll be 10 years old. So we have a 10-year-old, I want a 9-year-old girl right now, and an 8-year-old boy, and we have a 4-year-old girl and a 2-year-old girl. So definitely life is busy in the Handford home. And so you can certainly go to the website, find out more information about us there. If you want to find out more information about us and our group, obviously you can go to our website, PassiveInvesting.com. I'll type it into the chat box for those of you who are on here right now. If you want to find out more information. And then we also have some of our current offerings that are available. So we have this Riverside Flats at Aberfoyle Village. If you wanted to click on this current offerings, you can click on this right here and it'll open up the actual information page on this particular offering. So this one was actually released earlier this week. So you can find out more information about this one. It is open to accredited investors only, but if you're an accredited investor and you want more information, you can fill out your name, email, and phone number here, and you'll get access to the offering memorandum that has been put together for this particular acquisition. If you want more information on the other project that we have going on right now, which is Braxton Cary Weston, this one is closing in the beginning of November. So the first week of November is when that one should be closed. And then the other one that I just showed to you is supposed to be closing in December. So you have a little more time on that one. But both of these are available for accredited investors only. And again, you can go to the page, fill out your information, and get access to the offer memorandum. And I will type these into the chat box just so you can actually have them to be able to review instead of having to go find them somewhere on the website. So if you wanted to click on those, you could. Look forward to partnering with you on one of our future projects. If for some reason you're not ready to invest right now, but you want to follow us and learn about some of our offerings, if you are an accredited investor, you can click on this little blue button at the top right-hand corner here that says Join the Passive Investing Club. There'll be a little form here that you'll fill out, and you'll submit that. And then I'll jump on a phone call with you one-on-one to discuss your investment goals to make sure that we are a right fit for each other. So with all that said, I'm going to turn the screen off here and we're going to go dive into some of these questions that have already come in. So let me see if I can open up some of these questions. All right. So the question here is, first question coming in is, how much of the deal percentage do you offer the loan guarantor? So in our projects, we don't have a separate or outside loan guarantor for our projects. We do all of that in-house. So between myself and Danny on our group, we do all of the loan guarantee work. Now, the question might be, if I was to bring somebody else on, how much would I give them? So typically you're going to see the loan sponsor or the loan guarantor asking for 2 things. So first thing they're going to ask for is a fee called a guarantee fee, and that can range anywhere between 1% to 3%. I have seen it as low as 0.5%, but they usually will want more of the GP percentage in order to get a lower fee spread like that. So there's typically a fee up front that is paid, and then there's also a percentage of the GP that they're given. And that usually ranges anywhere between about 10 to 30%, most commonly about 10 to 15%, but it really just depends on how much that deal sponsor is putting or actually doing for the project. So are they bringing on the equity partners? Are they just bringing their balance sheet, their net worth and their liquidity, and just signing the documents? Or are they doing some additional asset management duties? So there's a lot of different factors that go into how much of the GP percentage you're actually going to give to your loan guarantor. I mean, I've seen it as high as 40%, which I think is a little bit high, but again, it just depends on what that loan guarantor is actually planning on doing. 4 kids. You must have been really bad in the previous life. Well, it's kind of funny because my wife and I, when we first got married, she always said that she wanted to have 5 children because she's a big basketball fan. So and it's kind of funny because when I grew up, well, I guess I still haven't grown up. It depends on who you ask, but when I was growing up as a child, at my parents' house, we never really watched a lot of sports, but my wife and her family watched it all the time. And she's a big college football fan. She's a big college basketball fan. Her team has always been UConn, the women's UConn. And so it was funny because when we had our first child, the one that's getting ready to turn 10, when we had our first child, of course, in the hospital, every 12 hours, you have a shift change with the nurses. And it was in November, right? So what's happening in November? It's like the heat of the college football season, and coming up to be kind of choosing with the bowl games and stuff for the next month. And she had ESPN on when she was in labor watching college football. And so every 12 hours, there would be a shift change with the nurses, and the nurses would come in and look at me and go, "What are you doing? You're watching ESPN and your wife is in labor." And of course, I would look at him and go, "It's not me. You could turn it off for all I care." And they look over my wife and she just kind of do this, "Yeah, you're right," that kind of thing. But because she always wanted 5 because she wanted to have a full basketball team, right? Well, on the last one, the 4th one, she looked at me and she said, "I think we're just going to sub in. I'll just sub in for the 5th one," right? And so I think we're going to be done for the 4, but they're definitely a blessing, and you can actually see them there in the background. If you can see that picture there, see if I can get a little closer. These are the 4 kids here. You can see them there a little bit. So anyway, always good to talk about family a little bit too, kind of get a little behind the scenes, if you will. Let's see. So another question is, are you the main owner and operator for the Riverside or just the syndicator? So we are the main operator and owner on the project, and we are I think the question is more, are you just raising capital for it, or are you actually the main operator on it? And we are the main operator on it. So because we're the main operator on it, we're still a syndication group. And so we would still be considered the syndicator, but because the syndicator is also the one who is putting the whole project together. So we found this deal, we're putting the project together, we're raising the capital for it. And so we're doing everything, I guess, if you will. So we are the main different there. Let's see. There are many different variations of legal documents out there in the syndication world. How many variations of PPMs and operating agreements have you reviewed, and how do you know you have the right one? Do you always use the same template now and going forward? Well, this is actually more of depending upon the attorney that you're using. So in our situation, we've actually used 2 different attorneys for some of our syndications that we've put together. And we have each attorney is going to have a different set of documents that they might actually rely on as their initial template as they're putting together your offering documents. And so I'm right now in 31, 32 different, investments myself, my wife and I, and with like 9 or 10 different operators. And so I've seen quite a few different offerings, but I've seen some that are similar, because I know some of the groups that I've invested with actually use my attorney that we're using right now, or our attorney as far as our securities attorney. So some of the documents will be similar. But there's certain key things that you want to make sure that you have in there. And that's why it's good to have the right attorney to be able to help you make the decisions as to, the different changes that you want to see in these different documents. So I guess the question is it's kind of a document that we start off with a template with the attorney, of course, and they'll usually take some of the suggestions that we have made in there from prior offerings and incorporate it into the new one that's coming up. So every offering is just a little bit different on some of the language and explanations, and trying to make things more clear and concise for the investors. So Chad has a question here, is has your criteria changed for what you are looking for in a property from when you first started? And if so, what made you look at something different? So the answer to that question is yes. So when we first got started, we were looking inside of the assets that we felt like we could take down from an equity percentage, from an equity standpoint. So in the beginning, we felt like, being able to bring in the equity amount of between about 2.5 to 3 million was kind of our sweet spot. And so one of our very first deals that we put together was a 130 unit property, and we paid right around 8.9 million for that one, and we raised right about 2.5 million, I believe, on that particular project. And it was probably the hardest raise I've ever had to raise money for, because it was our very first one that we were raising all the money for. And so it was a lot harder to be able to get all that money in. And it took us the full 60 days to get that money in. Obviously, it was our first project, things like that. So it took a little bit longer. And it was a C class property, and it was in an area that had been regentrifying. And so we found that when we took over that property, we found that there were, obviously a lot more things that you just don't know about on a property, like, different deferred maintenance items, or different things that, because it's an older vintage, it was a 1970s vintage, 1980s vintage property. And so the older the property, the more things could actually go wrong. Right. And so those are the things that we had to work through. And over time, as we were able to raise more equity, we were able to go and acquire nicer properties. And so we also have, about a year and a half ago, 2 years ago, we looked at the current environment, and we saw that a lot of the cap rates are not that much different based on the asset classes right now. They've compressed so much where you can actually buy C class properties for what we're buying B plus and A class properties for, as far as the cap rates are concerned. And so being able to buy a property that has lower risk on the front side, and even throughout the hold period, because it's a younger asset, allows us to create some more consistent cash flows for our investors, and it's a lot more predictable. Now, the overall returns are typically lower, but you also have a lower risk involved with it as well. And so it's that risk reward ratio that we're constantly, monitoring. And now, instead of going after those B minus, C plus assets, or C minus assets, or C assets, we're going after B plus with value add in an A class area. Or not well, it's in an A class area, but then we're also looking for an A class asset as well. And those A class assets, we're not talking about like downtown high rise spending $3, $4, $5, $6,000 a month in rent. We're talking about the suburban class A class assets, where the average rents are between $1,300 and about $1,700, $1,800 a month. So these are kind of what we would call affordable class A's, not your kind of urban downtown style class A's. So let's see. Do you participate? Oh, hold on. I got another question over here. Hi, Dan. I am currently house hacking. How do you suggest I go about purchasing my next duplex? Should I use the BRRR method, the Burr method? So I will be honest with you. I am not the best person to ask that question, because I have never used the Burr method. I know what the Burr method is. I think it's a great strategy. I've seen a lot of people use that strategy very effectively. And if you are currently house hacking right now, which I'm sure maybe you're currently in a duplex right now, where you're in one side and you're renting out the other one, which is that one renting out the other side. Shall we pay for the mortgage on both sides? That'd be, or the one mortgage for the whole building. And then being able to go to buy the next duplex and do a similar thing is obviously, beneficial as well. I know there's some time component strategies in there as well, with how long you can be for like a first time home buyer, or how long you have to be in the existing residence for you not to have like loan violations, if you will, or lender violations. So it's definitely not the best question to ask me, because I've never done it before, but I know it has as a great strategy. So sorry, I won't be able to help you too much on that one. Let's see. So here's John's asking about, what does an exit look like in year 5 with 10-year agency debt with yield maintenance? Would buyer have to get a supplemental loan for an assumption? So it is possible that in a 5-year hold, depending on what the yield maintenance is, that you might have to do that. So right now, interest rates are coming in around sub 3% for some of these larger multifamilies that we're acquiring. And so we typically do use yield maintenance on our holds. And the kind of thought process behind it is that over the next 5 years, the interest rates are going to be about the same or maybe a little bit more, or they might be a little bit less. And so you have to, it's more, you're getting into that kind of that stage of speculation. And so that is that is an option for a new buyer who's coming in 5 years. If the yield maintenance spread is too far, that you have to assume the loan and then they just get a supplemental loan on top of that to be able to acquire the asset, or they just raise more equity to be able to acquire the asset as well. Now, I actually, just a few minutes ago, I'll probably say a few minutes, about an hour ago, I did an interview with somebody on my podcast. So if you guys haven't been to our podcast yet, it's a Multifamily and Investor Nation podcast. You pull up iTunes or Google Podcast or wherever, you just type in the word multifamily, will show up there, Multifamily Investor Nation. And on that podcast, I interview people who are actually closing deals right now. And there was a gentleman that I just interviewed. His podcast won't release for another week or two, but he did an acquisition earlier this year. He got it under contract in June, closed it at the end of August, and got an interest rate of about 3.8%. And we had a kind of debate and discussion around, should he have done yield maintenance? Because he actually did step down prepay. And his was still a 5-year hold. And the way the step down prepay works is they do 5544332211, right? That gets you the full 10 years. And that's the amount of percentage of prepayment penalty you would get on the current loan balance at that time. And so in year 5, because they had interest only, the full loan balance would still be there, and they would at that point have a 3% prepayment penalty. So that's 5544332211, right? So you have that penalty, but then you also have to balance the step down prepay. He's getting charged 3.8%. Whereas if he would have done yield maintenance, he would have had more cash flows during the hold period, because he got an interest rate of 3.3% quoted to him if he did yield maintenance. And so he had to do an analysis to determine which was going to be the best option for his group. Was it going to be to do the 3.3% to get the lower interest rate now, and then, kind of betting on the fact that it's not going to go down too far 5 years down the road? Because if it goes down too far, then of course they have to pay the difference in that spread. If the interest rates are at the same or above, then there is no penalty at all. And so it's kind of a speculatory decision-making process. But for them, they made that decision because having the step down prepay was predictable, and they could underwrite for it, and they had the ability to know where they were going to be, and the numbers made sense when they were projected to exit in that 5-year period of time. All right. Wow, I got lots of questions coming in here, so I'm hoping I have enough time to answer all these questions. Some of them are pretty detailed, so let me see here. Let's see. Got those. About how many properties do you underwrite before you find one that pencils? So we are typically underwriting anywhere between 30 to 50 properties before we have one that and when I say underwrite, let me back that up. We don't underwrite that many deals. So we can typically look at the investment offering memorandum before we go into a full underwriting to determine whether it's an asset that we really want to go after. And once we find out that's an asset that we want to go after, we'll fully underwrite the deal. But usually we're going through about 30 to 50 deals before we find that one that really makes sense for us to go full on to try to fully underwrite a deal. We might pull out a quick deal analyzer to kind of put some rough numbers in the spreadsheets to see if it makes sense. But a lot of times it doesn't make sense there, and so we pass on it. And so once we have that one deal that makes sense, then we go and send it over to our analyst that works for us, and he will go in there and do the full, pulling in the T12 and the rent roll and put it into the model and things like that. And then we go into a deeper dive into determining whether or not we want to go tour the property and things like that. In the very beginning, we would tour as many properties as we could because we were trying to build relationships with these brokers. And the more we showed up, the more action and our activity they would send us along our way as well. Do you participate in the due diligence process? So I am participating in the due diligence process from afar. So what I mean by that is Danny and Brandon are the ones on our team that usually go on site to the property. And then Brandon works with a property management company to go over and walk all of the units in the property to make sure that they are what they say they are. And then Danny on our team works on the financial side of things, and so he's working with the property management company while they're doing those walks to actually do all of the lease audits and financial auditing and things like that while they're doing their due diligence. While they're doing the due diligence, once they get all their data and their information, we have a phone call that actually will dive deeper. And even our director of asset management is there helping out with that process as well. We'll have a group call to go over the findings to see what other things we might need to do change wise, things like that, whether it be changing the interior renovations or changing the business plan from an exterior standpoint, and making those decisions as a group, as a whole. So I don't go to the properties and actually do a lot of the on-site due diligence. That's reserved for Danny and Brandon, who are, I mean, really much better at doing that than I am. And they're going in there doing that data gathering piece of it, and then we kind of join together afterwards. Let's see. I'm reading one real quick. So let me read you real quick on Racine's real quick. She says, "Hi, I'm reaching out from Indianapolis. Beginner question. This will be our first property. My wife and I were looking into an FHA 203K to get a duplex, rehab, and rent it while living on one side. We went through the steps of the pre-approval. The loan officer told us that with the great credit we have, she doesn't think the FHA is the best idea. She said she had a regular conventional loan that has a 3.5% down payment on a 3.25% interest rate. She advised we find a house that doesn't require a lot of remodel, and take out a HELOC after the mortgage and do the renovation. It can only be a single family for this loan that she has. We were more interested in multifamilies and rehab properties to be able to cash flow immediately. I mean, for me, if I was looking at this, I would say I definitely would want to be inside of multifamily, right? Because that's the whole purpose of being able to be in a duplex like that. And even though you might have a little bit better, loan terms, you have to look at the underwriting, right? You have to look at that modeling and model it out both ways to see if we put in this particular conventional loan versus the FHA loan here, which one's going to provide me with the best returns overall. Because you might have a higher interest rate or higher down payment on an FHA or whatever the case may be, but your overall returns might be better because of the strategy that you're using for the rehab and being able to live on one side or rent out the other. So you have to kind of look at it on both ways and model both of them. Don't always just take it from the lender's perspective. Take what the lender says, put it into your model, and say, we see which one works and makes sense. Because you might be able to go back to that lender and say, I know I might get better terms with this conventional, but with the FHA, even though it's a little bit more or whatever, my returns overall are better because I can buy the duplex that I want and not have to and then be able to have higher returns, because there's a higher return potential when you have the multifamily property like that. Let's see. Next question here. What areas of Florida are you looking into for investment? So right now we're looking inside of Jacksonville. We were earlier this year looking inside of Orlando, but we've kind of put a hold on that right now because of COVID. And it's because there's a lot of unknowns right now with how fast, Disney's going to recover. And with Disney being the number one employer inside of Orlando, there's just some unknowns there, right? And so right now we're in Florida, only looking inside of the Jacksonville, Florida market. I understand Phoenix, Tucson, Dallas, and Fort Worth are all different markets with different characteristics and cap rates. But if you ranked in order your first to last preferred market to invest in regarding buying a 60 to 100 unit multifamily property between these four options, what would your ranking be? First preferred, second, third, and fourth, and why? Let's see. Well, I would say number one would be Dallas. Number two would be Fort Worth. Number three would be Phoenix. And then number four would be Tucson. So Dallas, Fort Worth, Phoenix, and Tucson. That is if I was doing that, right? Right now, our group is only focused here in the Carolinas, North Carolina, South Carolina, some in Georgia, and some in Florida right now. But with those four markets, it's based on the strength of those markets. Obviously, Dallas Fort Worth, I would kind of see as like one huge MSA. So really, that's kind of one. I think Dallas Fort Worth area is really expanding and growing. It has been for the last several decades, and I think it is continued and poised to continue to grow. Same thing with Phoenix. I think Phoenix has been over the last couple of years a really hot market, lots of great rent growth. And then Tucson mostly because I don't know a lot about Tucson, to be honest with you. If I was to choose between these three, that's the order I'd put it in: Dallas, Fort Worth, Phoenix, and then Tucson. Do you use a set per door price for due diligence, and do you always get into every unit? So we don't usually have a set per door price because a lot of things are going to change because it's going to depend on the actual NOI, the net operating income on that property, and how well we can perform that property. So it's not always about just the per door price. And then we try our best to get into every single one of the units. So pre-COVID, it was usually never a problem, but even and now into COVID, we've had some of the sellers say you only can have access to 25% of the units, and we're like, nope, we want 100% access. And we understand if some residents might say no, but it's been very few. So I'd probably say 90 to 95% of the units we're getting into. The only ones we're not getting into are the residents that just are not comfortable, or maybe they actually have COVID or something like that. We're not going to walk into their units if they don't want us to. How many days do you set aside for due diligence? And do you use a separate expert for every area of the property? So yes, we do have a separate person for each area of the property when it comes to the inspection piece of it. And those are usually done not usually the same day as we're on site. Those will be done over the process of the due diligence period. But we set usually between about 2 to 3 days to be able to do that due diligence because we have a team of people that will help us with it. So it's not just Danny and Brandon that are on site doing the due diligence. They have a team of people. So they'll usually kind of swarm onto the property with about 15, 20 people to be able to do the due diligence process, to be able to get through all of the units. And they have a checklist that they'll go through when they're walking through the units. And then they'll also have the checklist for the lease audits. And that's where we can actually get the demographic studies and things like that for the residents that are on the property. Let's see. How do you get funding if you lost your job? So one of the great ways to get funding if you have lost your job is to build a track record to a point where you can find somebody else that you can partner with who has the liquidity and the net worth to be able to get the funding to be able to acquire the properties. So even if you've lost your job, maybe the bank won't give you a loan, but maybe they'll allow you to have a loan through somebody else that actually knows, likes, and trusts you. So that's another way you can do it as well. All right, I think I answered that one. How do you figure Class A interest only investor amounts to raise? So it's a lot of it just depends on the return metrics. So and we can kind of play around with that a little bit because the more Class A you give, depending on where it's at. So we do 9% on our Class A investment. So we have, I think you're talking about the dual tiered structure here, Devin, and correct me if I'm wrong, but you have the dual tiered structured interest. And so you're not interest, but preferred returns. And so you have a 9%, we do a 9% preferred return on the Class A shareholders, and the Class B shareholders get a 7% preferred return, but they also get participation in the upside. And the preferred equity piece is that Class A shareholder who gets 9% preferred return, and they're in a preferred position in the capital stack. So they get paid first out of the cash flows. They also get paid first when there's a capital event on the property at the same time. And so because we're at 9%, the more we give to more equity we allow for Class A, the higher the IRR goes for Class B, as well as the annualized return goes up. Now, what also happens is the cash flows for Class B start to go down. So it's a constant kind of balance between, well, how low will investors want the cash flows to be in Class B? But then how high do we want to make sure that the IRR is going for the Class B investors as well? So it's one of those moving targets where we kind of know right around where we want to be. We know we don't want to be too far down below about probably 4 to 5% when it comes to the cash on cash for that first year, or the cash flows that are distributed to the Class B investors that first year, since we're giving 9% to the Class A investor. And so it's the more Class A you give, the lower your cash flows, but the higher the overall return for the investors on the Class B side. And how high that goes depends on the differential between where the Class B is versus the Class A. So if you first underwrite a deal and you're at 10% and you have 9% Class A, and you start to split that off, you're going to start to see an increase in that Class B investment. If you underwrite a deal and it's at 9% and you give 9% to Class A, you can give as much 9% as you want to Class A. It's not really going to change the returns that much for those investors. So a lot of it's just going to be a moving target or factor based on the return metrics that your investors are looking to see. Can you quickly explain what is yield maintenance? So yield maintenance is when you have a loan that is securitized at a certain interest rate. So let's just say 3%, right? So you get a loan at 3% interest. Well, 5 years down the road, if you have yield maintenance and the interest rates at that time are 2%, then for the remainder of the term of your loan, you have to pay the difference between 3% and 2%, which would be 1%. So you have to pay the difference for the life of that loan. So it could be pretty significant it could be a pretty significant amount depending on where you are. But it also can be on the other way around, where if you start off at 3% and the interest rates are at, say, 3.5 or 4%, when you go to sell the asset, now you don't really have any yield maintenance at all, because the lender can now take that money away from you when you sell the property and go place it with somebody else and make more money off of it. So they're basically just trying to secure at that particular moment in time the interest rate for a certain period of time, right? And if you back out sooner rather than waiting to the full life of the term of that loan, then you have to pay the difference in that yield, right? And so there's basically it's the way for the bank to be able to secure the amount of money that they're going to make off of that particular loan. Let's see. Answered that question there. When starting out and acquiring multifamily, based on your experience, should a person start out in the $25 to $50 range or 100 plus range instead? It really depends, Rich, on you, right? Because I know some people are like, I don't feel comfortable going after a larger one until I have a smaller property, right? But my group, we went after the large properties from the very beginning. So the very first property that we acquired on our own with no other partners was no other, like, we didn't like co-partner with another group, was a deal was 130 units, right? It was 130 units. So it was an $8.9 million project. And we've just kind of grown since then. But I know some people that would prefer to start smaller, and there's nothing wrong with that. You can start smaller. If it was me, I would probably want to start larger. And there's different groups out there that will help you from an education standpoint as well, whether you want to start out large or start out small. And so you just got to make sure you interview these various groups out there that can be a mentor for you to see where they would suggest you starting and where they can help you. Right. I decided to hire a mentor in the very beginning that had started out in the large space, and he continues to be able to acquire in the large space. And I wanted to follow in the footsteps of somebody like that. And so it really just depends on you and how motivated you are and what you want to do as far as getting started. During underwriting, if you find that a property will have a tax reassessment triggered due to the sale, do you try to renegotiate the price based off of the potential increase in taxes? So we already know that going in. So the markets that we're acquiring in, we already have underwritten for that potential increase when we make our offer. So we go ahead and make the offer based on that increase already. And so it would be very wise for you to know what those tax assessment rules are or laws are in your particular market that you're acquiring that property before you even make an offer. And a lot of times with the space that we're in, these sellers will ask us how we underwrote for the taxes, because if we're way off, then it could really affect the DSCR, because the bank is going to calculate it in there as well. It could hurt proceeds, and it can hurt our ability to be able to close that deal. What are you expecting with the overall multifamily market once the moratorium on evictions expires? Well, we haven't really seen a major impact on our properties with the moratorium. And I think it's because of the quality of residents that we have at our assets, because we're in that B plus and Class A space. I know some of the lower end properties have seen an increase in non-payment on their properties because of the moratorium. But I suspect that it will obviously overall help, because right now the demand for multifamily, especially in the Southeast, has just really kind of skyrocketed, because it was kind of what I would call the great relocation or whatever, with people, moving out of the Northeast into the Southeast area, and really, trying to find a place to live down here. I had a friend of ours, a person that works for us, that moved to Ohio recently, and when she was trying to sell her house here in South Carolina, she had 37 tours within a 2-hour period of time, and ended up selling it to somebody. They had 12 offers on the property, but they ended up selling it to somebody that had higher offer than their asking price, all cash, no contingencies, can close in like 2 or 3 weeks. And so that's the kind of demand that is happening right now here in the Southeast, because of COVID, and people moving away from areas that are not as advantageous to live in at this time because of COVID. So we're seeing that same thing on the West Coast, where the West Coast is moving more east, going more into Phoenix and Denver and Dallas, and then those kind of areas. But we're still seeing that great migration happening across the country. All right, I'm going to take probably 2 more questions. I have probably about 30 more that are kind of in the pipeline here. It's great. It's great to have you guys in here. It's awesome. Um, what do you think about a fluctuating rate as opposed to a fixed rate on a Fannie or Freddie non-recourse? I think it's a great option to look at, Carlos. I don't think it's a negative thing at all. I think interest rates over the next several years are going to be continue to be on the historical lows side of things. Now, obviously, I'm speculating at this point when I say that, but I think most of you on here would agree that the interest rates will likely decrease over the next several years, or at least stay as low as they are right now over the next several years. At least that's the posturing that we're seeing from the Federal Reserve as well. So I would not be opposed to a fluctuating rate, as long as you purchase a cap rate, right? And so you're actually purchasing a rate cap on how high your interest rate could go, because you can always obviously underwrite and create some sensitivities around that as well. Let's see. What would be an appropriate amount of leverage in a $1.5 million portfolio? Well, I mean, I think it really depends upon what's in the portfolio, right? Obviously, trying to keep your leverage on the low side. So I would say, if it was a newer property before you did any renovations, 70, 75%, maybe 80% on the top end, depending on the level of renovations and how fast you could renovate them and increase the rent. So that would decrease that loan to value as you are doing renovations. But I think overall in the portfolio should be around that 65 to 75% range, somewhere around in there, preferably in that kind of middle of the road 70% range on average. All right. What are your thoughts on syndicating locally within 150 miles? Are any thoughts on syndicating with properties outside my local market? Well, you can syndicate it anywhere in the country, right? You don't have to necessarily just be next to your property. I actually right now live in Columbia, South Carolina, but I syndicate projects primarily in the Carolinas, but I have some in Dallas. I have some in Dallas, Texas. I have some in Houston, one in Houston, and Knoxville, Tennessee. And then we're expanding out into the Georgia and Florida markets. But I don't invest at all in my own city here where I live, mostly because I don't think there's enough market stability to be able to invest inside of Columbia, South Carolina. So I choose not to. And I even live here. So it'd be a lot easier for me to be able to, acquire assets which are, in my backyard. But because of the market conditions that I'm just not very, keen to wanting to invest in it, we don't invest here. So we invest in areas that usually takes me about an hour and a half to maybe upwards to 3.5 to 4 hours to get to one of our properties, depending on where it's located. And so it doesn't necessarily mean we have to. So that's why we don't mind trying to look inside of Orlando, Florida, or Atlanta, Georgia, or Jacksonville, Florida, to be able to acquire properties. We can do that because we have the economies of scale now. We have the team built out. So we need to go to our properties. We're a short hop over there to those different areas to be able to manage those assets effectively. So I got one last question here about my findings for Georgia. So the only real area inside of Georgia that I would like to invest in or find some assets in is Georgia. And we actually have a couple of properties that we're looking at right now. Matter of fact, Brandon was in Atlanta today. He flew over for about a 2 or 3 hour tour of a property, and he's already back here in Columbia. Well, actually, he's going to be back here in Columbia in a couple hours, finishing up some property tours down there in Atlanta. So we are looking in Atlanta. We like the Atlanta market quite a bit. Obviously, there are certain pockets in Atlanta that we're not very amenable to looking at, but we're looking for those B plus with value add and those A class, suburban A class areas as well. We'll certainly keep you posted on those as we get closer to those, if they come to fruition, right? So last question I'm going to take here is about it's from Carlos. So he's asking, how's it going with your new studio? Are you almost done? Is there anything I can do to help? So the studio is coming along nicely. So it's been a little bit slower of a process, because obviously with right now, with a lot of the stuff that's going on with construction, it's been a little bit harder to find the time for our contractor to get things done, but they are working on it. And actually, I think this week they started doing some more stuff as well. And so hopefully in the next couple of weeks, we'll have a place to be able to move into and have a nice little studio to be able to be presenting our webinars in. So we're working on, and we're actually in the process of hiring a full-time video producer. So if you know of anybody who wants a position like that, it will be a full-time paid position here in Columbia, South Carolina. Send them my way. So we are looking for that special person to be able to help us out with a lot of our live streaming that we're going to be doing, and a lot of the YouTube videos and the webinars that we do in the podcast. So we're also going to be having that video producer walking around with some of our property tours and due diligence, and kind of getting some of the behind the scenes for our investors as well. All right. Well, thank each and one of you for being here on this special webinar edition, which is the AMA. I usually do the AMA about once a year. And so it's been a while since I've done my last AMA. And so I had a lot of great questions. There's a lot of questions in here I couldn't get to. So I appreciate you asking those questions at the very least, and looking forward to having you on for next week. And next week, let me see if I can actually get this page up, and I'll see if we have it ready. All right. So next week, we actually have a special guest. What we're going to start seeing moving forward is I'm going to be doing these webinars along with our team. When I say along with, we're going to be trading out some responsibilities a little bit here. So next week, I won't be with you. You will actually be having a webinar with Danny Randazzo and Kelly Garrett. So this is going to be, let me actually just get you this link here so you guys can register it, so you don't have to type all those characters out. So let me type into the chat box here so you can actually have this link. Sorry about the delay here. All right. So if you want to register for this webinar, you can do that here. And it's how to hustle for passive income with apartment syndication and private lending. So next Tuesday, 11 a.m., you're going to be listening here to Danny Randazzo, who's one of our other managing partners, as well as Kelly Garrett, who is the managing partner, one of the managing partners with Rehab Wallet, which is the private lending arm to the PIC Fund 1. And I'm sure they'll cover that a little bit there. They're going to be talking about different ways to build passive income streams, and also why invest passively in apartment syndication. So thank you for joining us, and we'll look forward to seeing you next week here with the Multifamily Investor Nation webinar series.